want to continue my discussion of insurance by talking about how insurance companies make money. Now, insurance is unique to most other businesses because you pay for the product before the company provides the service. Think about it. A spouse can't choose to buy life insurance after the person has died. They have to buy life insurance before the person passes away. But when it comes to other goods and services, for example, if you wanted to buy a TV, you'd go down to some electronics store and you'd hand them your cash and they would hand you the TV and you would take it home. So in the case of insurance, you have to pay ahead of time. And what this does is this gives insurers a positive cash flow that's known as float, which they can invest. And one of the reasons that Warren Buffett likes the insurance business so much is because of this float. And Warren Buffett is arguably the greatest investor of all time, or certainly of his generation. And so he knows the value of being given money that he can invest. And if you compare the insurance business to other businesses, not only do other businesses not have all this money coming in, they actually, in many cases, have money going out. For example, a store may have to finance their inventory, so they may have to pay for inventories before they're sold, or they may have to finance them through some sort of credit arrangement. Also, insurers have a future liability in the claims they will have to pay. Again, think about certain products that you buy. If you go down to an office supply place and you purchase a notebook, once they've sold you the notebook, they don't expect you to come back. You might return it, and if it was in good condition, they'd give you your money back. They'd put it back on the shelf and they'd sell it. But there's no future liability probably from the paper unless there's something defective in the paper and it just spontaneously combusts in your house and burns your house down, but that's not very likely. But in the case of insurance, when you sell the product, you've got to be careful about who you sell it to. Again, the office supply store, the Staples, the Office Depot, doesn't really care who they sell a notebook to or who they sell a pen to. But an insurance company really has to think about who they're doing business with in terms of who they're insuring. Now, insurers earn money from two activities. The first is known as underwriting, and that deals with evaluating the risks of insuring an individual or asset. So if you're talking about life insurance, a life insurance company, what are they looking at? They're looking at the age of the person they're insuring. Certainly somebody who's 95 has a much shorter life expectancy than somebody who's 25. They'll look at whether the person smokes or not, because smokers have a lower life expectancy than non-smokers. They may look at gender. Females tend to live longer than males. And so there are a number of factors they'll look at. If it happens to be an auto insurance company, they're also evaluating the risks. They're evaluating the risks of an accident or having the car stolen or vandalized. So they care about, again, the age of the driver. Younger drivers have less experience, tend to get into more car accidents. Also, the sex of the driver. Young female drivers tend to get in less accidents than young male drivers. They're looking at driving record. So someone with a lot of tickets or a lot of accidents is not a good risk. They also care about the location of the vehicle because that's going to determine the likelihood of it being stolen. Okay? The number of miles driven. The more miles that are driven, the more likely the person is to get into an accident. So a car that's not driven very much, that is stored in a garage in a nice part of town by somebody who's middle-aged and has a very good driving record, probably doesn't pay as much as someone who's young, who parks their car on the street in a not very good neighborhood and happens to drive a lot of miles. Underwriting profitability is determined by several ratios. The first is known as the loss ratio, and it's the losses incurred as a percentage of the premiums earned. So you take the losses incurred and you divide it by the premiums earned, and that's what we call the loss ratio. Then there's the expense ratio, which is the expenses incurred as a percentage of sometimes written premiums or sometimes earned premiums. But you take these expenses incurred and you either divide them by written premiums or earned premiums. And you have to distinguish between the two, because an insurance company may insure your car, but you may cancel the policy. So they didn't earn all of those premiums. And they may have to refund you. If you canceled your policy, they would have to refund you what they hadn't earned. Now, the sum of the loss ratio and the expense ratio is what's known as the combined ratio. And that really tells us what our underwriting profitability is. A combined ratio that's less than 100% indicates an underwriting profit. And that makes sense. If your losses, the losses you pay for, and the losses and the expenses are less than 100% of the premiums, then the insurance company has made a profit. Now, if they're greater than that, or they're 100%, they may have zero underwriting profit or actually a loss. The other way an insurance company makes money is, as we said before, they have this float. They get this money before they have to pay the claims, and they can invest them. And if they invest them well, they may be able to generate a very nice return. Again, that's why Warren Buffett likes the insurance business so much. So you can actually have a company, an insurance company, that has losses on the underwriting side, but is still profitable because of their investment activities. So if the investment return is high enough, if interest rates are high and they're able to invest the premiums in high return assets, high return bonds, for example, then a small loss on the underwriting side may not harm the insurer. They may be able to, in fact, generate a nice return for the company. Now, one of the things about insurance is oftentimes, particularly property casualty insurance, is subject to a cycle, sometimes called the underwriting cycle. Because during times of high interest rates, some insurers may be lax in their underwriting standards so they can generate float to invest, and that sort of makes sense. They'd like to have more money coming in. They don't mind that they're taking on some higher risk individuals because they feel that they can make it up by investing the money in bonds or something else that generates a nice return. When interest rates are high, insurance can be easy to buy. But as rates fall, insurers earn less income on the investments, and they may have higher payouts from poor underwriting standards. For example, insuring bad drivers. And when this happens, some insurers may fail, the survivors may raise premiums and use higher underwriting standards, making it difficult to buy insurance. And then, because of this, profitability returns to the insurance industry because of these higher underwriting standards, and then the cycle may start again with a change in interest rates. And we have had times in the U.S. where there have been casualty insurance, property casualty insurance crises where it was very, very difficult to buy insurance. A lot of playgrounds at times were closed up because the towns couldn't buy insurance to insure if someone were hurt on the playground. And so these cycles seem to take place where insurance is easy to buy, and then it's difficult to buy, and then it becomes easy to buy again, and it's a cyclical sort of thing. And a lot of that is driven by interest rates, and those interest rates entice some insurance companies to use, again, much more lax standards in underwriting and insuring bad risks, which tend to come back to haunt them. So, as you can see, insurance is a little bit different kind of business from your traditional retail business where you pay for something, and you receive the good right when you pay for it, and generally you're not worried about future liabilities. In the case of insurance, there are a lot of future liabilities down the road. Some can be very hard to project, and some can be very long. We call these long tail lines, very long, a long ways down the road. For example, liability. Sometimes when there are product liability cases, malpractice, it may not be known for years. Asbestos. There are a lot of suits. You may even see some of the commercials on TV for lawyers that will help you to file claims against employers where there was asbestos in the workplace. Now, we didn't, the insurance companies didn't find that out maybe for 10, 20, or 30 years. So insurance is a bit of a unique business, and it's quite different from some of the other businesses you're used to thinking about.